Good day, guys. Welcome to Forex Walker. Welcome to Arbitrage Trading with Calvin Ports. Welcome to episode 49. So, in this episode, we're looking forward to catching both commodity currencies and taking a hedge inflation or a hedge inflation arbitrage opportunity on those commodity currencies. Remember, commodity currencies, the theory that I have with commodity currencies is that in the southern hemisphere, uh, they move, they pump or they become bullish towards the closure of the year, which is the last quarter of the year. For the southern hemisphere, which is summer, and they move towards the festive season in the northern hemisphere, between March to June, which is the summer times on that side. So these commodity currencies or commodities in general, they pump towards the closure or towards the beginning or towards the summer season or the festive season. So that's just how the commodity currencies move. But here we're talking about two currencies, the New Zealand dollar and the Australian dollar, which are both correlated to China with the iron ore exports. So what we're looking to catch here in hedge inflation is the response of the economy of both those currencies towards the interest rate cutting cycle. Here you can see that New Zealand started its interest rate cutting cycle in August the 14th, 2024. The interest rates uh, were at 5.5%, and after the first cutting cycle, they actually became more aggressive. They started cutting interest rates with 50 basis points, three times of 50 basis points, and then they slowed down. So what we're trying to do is that we're trying to hold along those currencies ahead of the Reserve Bank responding. Because the Reserve Bank, how they respond is that they will decide to hold interest rates. Now, what they look into is the consumer inflation and all these other uh, inflationary economic reports. So here we're looking at inflation. You can see that this inflation was in a downtrend as the interest rate cutting cycle had started in 2024, but the inflation was not responding as they were cutting interest rates, so they became more aggressive. And as the interest rates went all the way down there, you can see that there was a tiny economic response here. So what happens when they cut interest rates is that the businesses are actually suffering from high interest rates, the businesses in that economy or that country. So they're actually suffering from high interest rates. So once they cut interest rates, it means that money becomes cheaper and cheaper. And when I say money, I'm talking about loans. So the Reserve Bank starts to loan the banks with lower rates, and those banks they start to loan the businesses the money with lower rates, and that's what I mean when I say money becomes cheaper. So if you want to take a loan, take it towards the end of a recession. When you see that this is the end of the recession, take a loan, take that mortgage, and that mortgage will be much cheaper for you to afford because the interest rates are low. So here you can see that this New Zealand inflation is responding well, is responding positively to the interest rate cutting cycle. We're starting a new uptrend here, which is something that we want to see when we want to hold, when we want to hedge the inflation that is doing well with the inflation that is not doing well in another currency. So those other currencies are not here. They are interchangeable. We'll see which currency we can hold, we can sell whilst we are buying this currency. So That's the strategy that we're trying to hold on those trades. So you can see that here the GDP in New Zealand was actually moving in a steady downtrend towards the negative, and it actually gave us a tiny turnaround, even though it's in the negatives. But you can see that it's responding to the interest rate the interest rate cuttings that were introduced by the Reserve Bank. So with that economic response, what we anticipate is that the Reserve Bank at some point will hold interest rates. As you can see, our interest rates are at 3%, and we're trying to or buy those currencies ahead of the interest rate hold. So this is where the Reserve Bank is holding interest rates after hiking. So we're looking for something straight like this. We're looking to see it down here, that where they hold interest rates. So when they hold interest rates like this, it means that the economy is either doing well or choking towards those the interest rate hiking, or because the Reserve Bank does not want to choke the economy. So here, once they start holding the interest rates, we know that the response in both inflation and the GDP in New Zealand are both telling us the same thing. They're directly proportionally telling us the same thing, because when you see that the inflation is responding, and when you check on the GDP is doing the opposite, you know that the currency is not ready. So here with Australia, what we have is that Australia started its interest rate cutting cycle on the 18th of Feb 2025, whilst New Zealand started on the 18th of August 2024. So you can see that today is the 18th of September. So here it becomes 1 year, 1 month for since they have started the fighting inflation, or since they have started cutting interest rates. So it sounds like it is unfair to compare the Australia, who just started the cutting cycle on the 18th of Feb. It sounds unfair for us to compare both currencies, but remember, those currencies are positively correlated to China with those iron ore exports. And we know that once New Zealand starts pumping, the Australian dollar will also pump, and that gives us the arbitrage opportunity to actually hold the currency that is delayed and hold the other currency that is ahead. So those are the things that we're trying to do. We're trying to jump in ahead of the Reserve Bank. So you can see that since they started cutting the interest rates, in fact, those interest rates are not far from each other. Look at here, we have 3% for New Zealand, and here we have 3.6% for Australia. So both interest rates are good for in turn for holding that positive carry. So here you can see that since we started before the interest rate cutting cycle had started, the inflation in Australia was collapsing, and it keeps collapsing. It keeps forming lower lows. And the GDP here, you can see that since they started the interest rate cutting cycle, it is actually responding positively to the interest rate cuts. It is actually moving higher and higher, which is something that when you want to hold a currency, you can see that this currency is not ready because inflation keeps collapsing, and that means the country will not stop cutting interest rates. They need to cut at least 3 times or 4 more times compared to the other currency. But New Zealand is ready to hold interest rates. But at the moment, you can see that the GDP in Australia is doing well, but is responding well to the interest rate cutting cycle, but inflation is failing to respond to them. We just want an uptrend that looks similar to this, where you can see that the country is responding And once we see that uptrend, we know that Australia is about to hold interest rates. So that is the hedge inflation trade that we're trying to catch on the other side. So here you can see that this is the New Zealand dollar that tells us is collapsing, even though it's pricing in some positive economic reports. So we're looking at it. It's we're expecting it to drop all the way down, and so that when we are sure, when the Reserve Bank start talking about some hawkish stance, or some where they decide to hold interest rates, we know that this currency will become a little bit hawkish. It will become a little bit bullish. So hawkish actually means that they want to either hold interest rates or hike interest rates. So, but what hawkish means is that the currency will become bullish. So what I'm trying to tell you is that once we get that touch on, we actually have another shoulder down here. I hope you can see it, another shoulder. So we're trying to hold this currency long term, and this is the Australian dollar. We're also looking forward to holding the Australian dollar, even though the GDP is responding positively, but the inflation is not yet responding towards the interest rates, the interest rate cutting cycle. So at the moment, we're just observing the currency, but when we get that hedge inflation trade, let me show you what hedge inflation trades do. I don't like doing this, but this is something that we need to do. Hedge inflation trades, they give you an uptrend. This is 17 March. I hope you can see the date down here. This is 17 March. This is the 13th of 23rd of March 2020. And the uptrend was held all the way up to 2024. So it's like a 3 year trade. It's a trade that takes 3 years. So this is something that we're trying to take advantage of. We're trying to we're trying to hedge the inflation on one currency with the inflation on another currency, meaning that the other currency is not doing well, or the other currency is beginning an interest rate cutting cycle, and the other currency is exiting the interest rate cutting cycle. That's just something that we mostly look into. So here you can see that this trade actually takes from 2020 to 2024. It's like 4 years of an uptrend, and that's what we're trying to catch in this trade. So this is what we call arbitrage trading. These are the arbitrage opportunities that we are trying to take in this in both these currencies. It does not necessarily mean that the currency that we need to sell has to be the JPY. It can be any other currency. It can be any other currency. What you need to know is that the JPY is inversely proportional to commodities and stocks. So what happens is that when you get a pump in the JPY, you get a collapse in the commodities, and the volatility index is actually directly proportional to uh, the uh, the JPY. So when you get a pump in the volatility index, you get a pump in the JPY. And when the JPY, when the volatility index collapses, when it collapses when all economies are doing well, and when economies are doing well, that means the commodities are doing well. So that's the reason why we have to choose these oppositely correlated currencies to hold these trades. Guys, I'll see you on the next episode. Goodbye.